put money in the POs or in the invoices, it always automatically goes to accounts receivable and accounts payables. We don't have to do anything physically to put them in those
Right,
accounts.
so yes, that's correct. When not for POs though, for bills and invoices. So when you receive a payment for a customer, it
Right.
automatically reduces the receivable and adjusts the receivables. And likewise, when you pay out for the vendors, it automatically adjusts the accounts payable.
Okay.
Remember, I said earlier, you don't need to use a journal entry. Once you choose the right form for transaction, it would it would do the correct adjustment.
Right, right. Okay, no problem.
It knows exactly based on the form you choose, it knows exactly which account is affected. All right, any other queries? So remember, you don't need to use journals. So we come across, if you use somebody who's using journals to record transactions, you know that they're not that it wouldn't record, but you know they're going to limit the use of the program.
Yes.
All right. So journals are ready for adjusting. As on through our discussion, once you choose the right form, QuickBooks can know which account to adjust when you're recording transactions, and it can automatically create the journal entry for you. All right, so we're gonna save and close. So when we go back to our trial balance, you will see that we no longer have income or expense balance, and that has been transferred or adjusted to our opening balance equity, which is the adjustment account that we're using. Okay, so let's go to page 23 and enter the opening balance for retained earnings. So the opening balance for retained earnings is equal to your opening balance equity after all the opening balances are recorded. So the opening balance for retained earnings is what? Equal to the opening balance equity after all of the balances have been recorded. Okay, so let's go to how to enter these. So we know that the retained earnings is equal to the opening balance equity. So how do we enter the retained earnings opening balance? From the chart of accounts list, chart of accounts, page 23. Right click on the retained earnings account. Click edit account. Click enter opening balance. Enter the opening balance total that is left. Enter the closing date. Tell me if you have any questions before I click OK.
The retained earnings is account automatically created by QuickBooks?
Yes, you
Okay.
QuickBooks, the retained earnings is an account that is created by QuickBooks. And the opening, that is the net amount of all the balances recorded. So that account is a special account used going forward for where the net income is posted to. So you don't actually have to post to it, but to put in the opening balance, you just edit it and enter the opening balance. Any other questions? So retained earnings is just basically retained profit, but the opening balance is taken from the net opening balance equity account after all the balances have been recorded. But going forward, you don't post to it, automatic QuickBooks will post to it. It's an account created by QuickBooks. Any other questions? Any other questions?
No, please.
All right, so we're gonna click OK and save and close. So when we go back to the trial balance, you would see that opening balance equity, well, it's supposed to be 0, so like I put in the round total there. So it's supposed to be 18 and not, I put in the wrong amount, so it's 21. No, something is off balance here, so we gotta check our balances. Something is not balanced because our total in the book supposed to be 21,786.30. So we gotta go back to our trial balance and see which balance is incorrect. So let's go back and let me double check. We should have, oh, accounts receivable supposed to be 68 and not 58. So let's double click on that balance. We have something that is out of balance. That's supposed to be 68. So let's see. Uncategorized income supposed to be 68 and not 58. So we have, so you can, this is a good example that during the setup process, you're allowed to go and edit the transactions. But of course, as soon as we go live, there are methods in which you are to make adjustments to any incorrect balances. So we have so this is a good example where we're reviewing the balances and realize that we are out. So let's see where we gone wrong. So let's double click on accounts receivable. So something is wrong here. It's supposed to be 24,75.68. That is correct. Let's see, categorized income supposed to be 22,75.68. That was correct. So that is not the one that is out. So something else is out. We'll figure it out shortly. So we off 88 cents. Um, 250, 100, 136. Oh, the sales tax payable supposed to be 136.98. So This is supposed to be 98 and not, so that is where it's off. So you could double click on the transactions during the setup process of the opening balances and make changes, but do not do this for no actual transactions. So that is where we were. Also, we're correct now. So again, the trial balance then was used. We use it for what the purpose is that we review the balances and make sure that everything is balanced. So now that all your balances are correct, on page 24, we're gonna set the closing date. So QuickBooks, in some programs, you have to do batch closing and so forth. To close the accounting period in QuickBooks, you just have to set the closing date and make sure all your balances are correct and set the closing date to prevent users from making changes. So you would log in as admin in single user mode, page 24, and then you will click on company and then click set closing date. Sign in as admin in single user, click on company and set closing date. From the company's preference tab, click set date and password or password. Tell me when to continue.
You can continue.
Can I go and click set date or password?
Yes, please.
Can I click set date or password?
Yes, thanks.
Yes, please.
All right, we're gonna select the closing date. So our closing date will be 12/31/12, and then enter the closing date password. So again, select the closing date, which will be the end of the accounting period. Some people use it close at the end of each month too as well. And then we are going to enter the closing date password. The only body who will have this is the accountant or the owner. And I'll show you what happens when we finish, when somebody goes to make a change to a transaction. So this is how you close off the accounting period in QuickBooks. You don't have to do any posting of anything, just make sure the balances are correct and set the closing date, and you would do this at the end of every period. So when we're ready to close off 2013, we will go back through the same process and just change the date to 2013. So we'll click OK and OK to save. So if we go to any transaction and we open it, and we change anything on the transaction. It doesn't matter. It could be the amount, the date, and then we try to save it, it will allow us to go through the process, but then it will bring up this field here. So it wouldn't allow us to make any changes unless you have the closing date password. So then it will just cancel, revert, and save and close. So it wouldn't allow me to make any changes unless I have the closing date password.
And these would be for all the transactions that would be before the closing date period.
Yes, for all transactions.
Okay.
All right, so let's go on to, let me take the register and then I'm gonna go on to the page 25. All right, so let's go to page number 25. We're gonna go through the process of how to enter a customer return check. So customer paid us, we deposited the check, but the bank returned it. So we're going through the process of entering a customer return check. Are we ready?
Yes, please.
Yes, thanks.
So to enter a customer return check, you're gonna click on banking, write checks, page 25. Banking and write check. Select the bank account, enter the check number RC. enter the date that it was returned on the bank statement. Select the customer name. Select the customer name. We have to add it because he wasn't part of our opening balance. So you select the customer name. So you're gonna just add him, quick add him on screen. So we select the customer name and we enter the check amount. So again, we click on banking, write checks. We have that note. Banking, writes checks.
Got it.
Banking, write checks. We have the note.
Yes, thanks.
Then we're gonna select the bank account, enter the check number RC, enter the date that the check was returned on the statement. We have that. Select the customer name, enter the check amount. We have that. From the expense tab, select the account, accounts receivable. And select the customer name from the customer job column. So select the customer name from the customer job column. So from the expense tab, select the account, accounts receivable, and select the customer name from the customer job column. We have that. Now, if I go to the customer center, you will see that Scott balance is 0 because he would have paid off his bill, but the check was returned, so we have to reinstate it that he still owes us $350. So when I save this check, it will reduce our bank account by $350, and it will increase the receivable back to $350 to let us know that Scott still owes us $350. So can I go ahead and save and close?
Yes, thanks.
So here we go. Scott's receivable is reinstated. Our bank is reduced by $350. As you see on the reverse side of the statement. Any questions? Any questions? All right, no questions. So the other thing we're gonna look at is that Before I go forward, let me go to the chart of accounts and add a few accounts that we're gonna need, and so that it would run smoothly. So we're just gonna add some income and expense accounts that we need to use going forward. So you're gonna go ahead and account tab new. So we know how to add an account. And I want to add an income account, other income. And we will talk about how these going to be used when we do the exercise. And we can also look at bank charges. So we want to add an expense account for bank charges too as well. So expense account, we're going to add for bank charges. So I don't have to add them on screen. All right, so we're gonna go back to the home screen. So on page number 26, the bank would have charged us $30, but we want the customer to pay. Yeah. So the customer is going to pay. We're gonna charge back the customer. Just hold a minute, please. Hold a minute. Sorry about that break in transmission. My sincere apologies. All right, so we're on 26. Are you still there? Hello?
Yes, I am.
Okay, great. Let me check to make sure everybody else is with me. Okay, good. All right, so we're gonna do the return check charges. So the bank charges 30. We're gonna charge the customer 50, and we're gonna make an extra $20 on administrative fees. So how do we record the bank charges and charge it back to the customer? So you're gonna click on banking, write checks. You're gonna select the bank account, enter the check number RC, enter the date that the charges were applied to the statement, select the customer name, enter the bank charge amount, and I'm gonna pause it there. Do we have the note? Do we have the note? Somebody
Yes,
asked,
Yes,
Ariana,
thanks.
this charge is the bank charge that's gonna come off our bank statement, this $30. But from the expense tab now, we're gonna select accounts receivables, and we're gonna enter the amount we charging the customer, which is $50. So $50 will be added to the customer account. So this will be the bank charge plus our admin fee. Select the customer name, tab to the next line, and select other income. So this is the admin fee that we gonna make a very profit on. So this is, so when we save this, the bank can be reduced by $30 as what the bank charges. The customer account gonna increase by 50, and then our income can be credited, which is an increase of $20. Any questions before we save and close? Any questions before we save and close?
No questions.
All right, so we're gonna save and close. And when we go to the customer account, the customer gonna owe us 400, which is the 350, and the $50 that we charge them. Then when we go to the bank account, our bank account gonna be reduced by $30. All right, and then if we go to our income account, we gonna have an increase of $20. So everything happened in one transaction. All right, so the next exercise that we're gonna have is that we're gonna receive the customer payment again for the $400. So on page 27, we're gonna call Scott, let him know that the check returned, the check is $350 plus an extra 50, and then he's gonna come in this occasion, he paid cash. So we're gonna go to customers, we're gonna go to receive payments. We are going to select the customer name, enter the amount received, enter the date it was received, select the payment method, which is cash. He paid this time, and take the return check transactions, which will equal to the $400. And then we will save and close. Any questions? Any questions?
No questions.
All right. All right, so we're gonna go to page 28, and we're gonna make a deposit with the cash that we receive, but I'm gonna show you how to do a cash back to petty cash. Meaning that although we received $400, we kept back $200 in cash. All right, from the deposit, but the emphasis is that we still have to record the full amount received. So to make a deposit with a cash back, page 28, we're gonna go to banking, make deposits. Banking, make deposits. Take the payment to be deposited. So there's a $400 in cash from the payments to deposit window. So you take the payment to be deposited from the payments to deposit window. You click OK. Tell me if I could go ahead and click OK. We're on page 28. Page 28. Tell me when to go ahead.
Go ahead, please.
All right, so from the cashback goes to, click on the drop down arrow and select the petty cash account. And in the cashback amount, enter the amount that you took from the deposit. And then we're gonna save and close. So as you can see, before we save and close, yes, we received $400, but the deposit total is $200. So we could go ahead and save and close. Can we go ahead and save and close? Yes, no, please?
Yes,
Maybe.
thanks.
Okay. All right, we're gonna cool down there, and we're gonna have a discussion of what we learned this evening. Go ahead, Ariana. Go ahead, Ariana. All right, I ain't hear Ariana yet. Cecile, go ahead with your comments.
Yes, good evening, everyone. Let's see. Everything is new, me. So, I'll go back through the notes. But yes, learned a lot. And
Any
just
highlights? Anything was a highlight for you?
not really a highlight, but it's like going through everything. So it's always information that's useful.
Mhm.
So yes. Yes, thanks.
Okay. Kira, are you hearing us? Hi, Kira. If you can hear and you can text your comments, you can do that too as well. Ariana, are you back with us?
Yes, please.
Go ahead.
Yeah, everything tonight was really great. I learned a lot of new things. Honestly, like from start to finish, everything was new, but um, I would say it was a lot of information, but at the same time, it was still easy enough to grasp. It's just to like have to go over everything, so there are no steps you miss out. Um, I don't know which thing to pick out from that was a standout. Honestly, everything was new and really interesting to me. From the journal entries, how we're not really supposed to make any changes to the journals. Everything we're supposed to change, we should really change from the transactions, given the fact that you're not really able to use the full extent of the program if you do it that way.
Mm-hmm.
Seeing everything move from when we move the stuff from uncategorized income and expenses over to the equity and closing off all the things. I found that was interesting as well. Being able to, once the accounts are finished for that year, being able to shut it off so that no one else is able to interfere with them.
Mm-hmm.
And everything else, to be honest, I mean, I could go on and just like go through everything we went over today because honestly,
Right.
everything was new and everything
Okay.
was interesting, but still easy to follow so far, I would say.
Okay. All right. Well, thanks for your comments. They were very good. Even if you had gone over that, would be fine because
Hmm.
we could it might kind of like heighten something that I might probably comment on or add extra.
Oh,
So
okay. Um, I think a lot of the minor thing, not minor, let me not say minor, but a lot of the additional notes you would have given us. So the specifics for the debits and credits, that was
mhm,
good. The on categorized, not that one, sorry. Right, the on categorized income being equal to the customer balance, the on categorized expenses being the vendor balance, both
right.
having to be adjusted to the opening balance equity. That was one that stuck out to me. Um, Let me just see. That's pretty three notes, right?
Right.
The
That's
bank
fine.
taxes, the debits going first. That was a new one for me,
Right. We talk about that.
right? I already mentioned this, but not using the journals to record entries, only ever using them to adjust the amounts.
Mm-hmm.
Ooh,
Because we talk about not that a journal is wrong, but just that it's not going to help you to utilize all the functions and features.
right, right. So you would end up kind of missing information when you're ready to do. I think you said when you're ready to do bank reconciliations, you would be missing certain information. You wouldn't have all the
Or you
specifics that you
can't
need.
filter the information properly, or like we talk about, well, they can be on the bank recs, but everything I got journals, so you don't got to try to figure out what was checks, what was deposits.
Right,
So
right,
they won't be labeled, the transactions won't be labeled.
right. Even when we were talking about moving the amounts from unrecognized, uncategorized over to opening, you were saying because you would have gone through everything and put everything in the correct transactions, we don't have to worry about it just being figures. moving over, because in our accounts receivables, everything would be um, recorded and individualized, itemized,
Right, right.
right? Um, what else? The opening balance, the return earnings being equal to the opening balance once they've all been recorded,
Mm-hmm.
and that being an automatic um, journal in account, sorry, in the chart of accounts. And we only
Mm-hmm.
have to go through it once, really,
Mm-hmm.
when we first open, when we first put it in the opening balances, and after that, everything will kind of generate for itself.
Right, that's a good point. Yeah.
Yeah.
And telling me helps reinforce what you learn to, because
Right. Right.
yeah,
Yeah.
right. One thing I would like to mention though is we finished putting the opening balances, and I just want to make that note that opening balances are only entered once when you're setting up the file for the first time. So after this exercise of doing the opening balances, we don't have to do opening balances again.
Okay.
Only at setup, but QuickBooks will roll over the balances automatically at the end of each year. So opening balances are only done once at
Yeah.
setup.
And then after that, you showed us how to how to close the year.
Mm-hmm.
Then we went through the checks. How we would return the check, put that amount back over to the customer so it shows that he still owes us an
Mm-hmm.
amount, and then also be able to add not only the bank charges that the bank would have charged us, but also any
Mm-hmm.
administrative fees that we would also let him incur given
Mm-hmm.
the situation. So yeah.
Okay, sounds good. All right, well, that was a great refresh of great overview. And I'm sure you enjoy, it kind of reinforced what we discussed today. So
Yeah.
thanks for your input. I'm not hearing Kira, but if no other comments, have a great evening and looking forward to seeing you next session.
Thank you, and same to you.
Thank you.
All
Have a
right,
good
bye-bye.
night. Thank you.
You too. Take care.
You as well. Good night.
All right.